Nexus Industrial REIT, ticker NXR.UN, officially missed Q2 2026 consensus. Revenue came in at $46.62 million, missing estimates by 3.12%.
Right, and EPS showed a net loss of $12.81 million, which is negative 13 cents per unit.
But guidance remains unchanged, targeting mid-single-digit same-property NOI growth. And yet, despite those ugly headline numbers, the stock actually rose about 1.4% to $7.90 right after the report. So why on earth did the market reward a stock that missed revenue and widened its net loss?
Well, to figure that out, we are looking straight at their Q2 earnings report, and the latest management calls for this deep dive. Our mission today is to separate the headline accounting noise from the actual, cash-generating machine.
Because that $12.81 million net loss was heavily driven by fair value adjustments, right? Like $26.5 million worth.
Exactly. It's essentially paper losses on the current appraised value of their properties.
Okay, so if the headline numbers are just paper losses, where do we look to see if the actual business is surviving?
You look at the underlying operational cash flow, specifically net operating income, that actually rose 6.2% year over year to $34.1 million.
Oh, wow. Okay.
Yeah. Plus, their industrial occupancy climbed to a very healthy 97%. They renewed 380,000 square feet of leases at an average rent lift of 6%.
That's huge. And current market rents are still sitting like almost 15% above their in-place rents. So the underlying demand is absolutely there. I mean, I look at it like this. It's like you own a highly desirable rental house. Your tenant loves it. They happily agree to pay 6% more every year.
Right, yeah.
And, you could charge even more if they left. But your adjustable rate mortgage recently skyrocketed.
That's right.
And it's just eating up absolutely every extra dollar of cash flow you bring in.
That is the perfect way to look at it. Their operational strength is actively battling elevated interest costs. And those debt costs pushed their year-to-date AFO payout ratio to a dangerously tight 99.3%.
Which leaves almost zero margin for error for retail investors who are relying on that 7.9% dividend yield. If they're carrying leverage of 10.7 times net debt to adjusted EBITDA, how are they getting the breathing room to fix the math before the dividend has to be cut?
So they are fundamentally restructuring their debt. Management recently managed to secure an investment-grade credit rating.
Nice. That helps.
Yeah, a ton. That rating allowed them to issue a $500 million inaugural bond, which they are using to clear out some of their floating rate term loans and, lock in more stable funding.
And they're also doing some asset recycling, too, like taking non-income producing assets and turning them into cash to pay down debt.
Right, like selling off their Hamilton development land for $14.1 million.
Okay, so fixing the balance sheet is one thing, but management also announced a pretty sudden pivot toward digital infrastructure. I mean, the CEO mentioned they are adapting micro-industrial sites in Richmond and Kelowna, BC, into data infrastructure.
Yeah, and traditional data centers take years to permit and build, but Nexus is sitting on sites that already have the power capacity and the local permits in place.
Got it.
So if they land the right tenants, it could yield massive returns way above their standard 6% development target.
I have to push back here, though. Are they genuinely sitting on a highly lucrative tech pivot? Or is management just, name-dropping data centers on an earnings call to distract retail investors from that razor-thin 99.3% distribution cushion?
It's a fair question, honestly. Real estate is littered with companies chasing the latest trend. The difference here is those existing power approvals. They've already broken ground and poured the foundation in Richmond.
Wait, really? It's already happening?
Yes, it's active construction. Converting a standard warehouse into a data center works because the underlying mechanism changes. If you ink a lease priced by the kilowatt hour of power consumed.
Oh, rather than the square foot of floor space.
Exactly. The economics of those existing sites fundamentally transform.
So what does this all mean for you listening? The bottom line is you're looking at a 7.9% yield, trading at a 39% discount to its $13.23 net asset value.
Right. The underlying industrial operation is thriving, but the balance sheet leaves very little room for error if leasing slows down.
It's a high-wire act.
Yeah, the operational cash flow simply has to outrun the interest expense while they execute this new strategy.
The market didn't reward a revenue miss. It rewarded a landlord fixing their mortgage and potentially finding a much richer tech tenant.
Exactly.
Which leaves you with this to chew on. If Nexus can successfully convert standard industrial shells into highly lucrative data infrastructure by the end of 2026, how many other traditional warehouse REITs out there are secretly sitting on unrecognized digital gold mines? Make sure to follow the show for your daily earnings coverage.